Hi, everybody. My name is Jonathan, owner at Trendy Trading. Thank you so much for taking the short time to watch this video. Make sure you get your journals ready. You're going to want to put down this information. Thank you so much. Don't forget to hit like and subscribe, and we'll see you in the future. Happy trading. Hey everybody, this is Jonathan from Trendy Trading. I appreciate you. Thank you so much for taking a few minutes here to watch this video. And I'll try to keep it as short as possible. Before we get started, please go and like and subscribe to my channel. I appreciate you. Today we're going to be talking about how to create your account allocation numbers and why it's important and know your numbers. So I have the camera on because I want you to be able to see me and hear me, because it's not really about the screen itself, although we could dive into specifics on the Greeks of options or even our bracket trades when it comes to equity and so forth. But really, it's about the information that I'm about to give you. Most traders, they come up with their first number by understanding how much they're willing to lose. What I'll tell you is, when you come up with that number, I need you to think about, in worst case scenario, multiple positions. So, you might tell me, hey, I'm willing to lose 200 bucks. You start to feel a little bit of FOMO. The market's trending, it's doing really well, and you find yourself at like 10 positions and you're willing to lose $200. So each one of those are traded accordingly. But when things hit the fan, and all of a sudden everything goes down, you've lost, let's say over $2,000, and that's not what you were expecting. So what I want you to do is figure out, in a worst case scenario, what are you willing to lose? And for some people, that may be different. It may be 2% of your overall net liquidity. It might be 5% and so forth. You need to understand what that is. And I'm telling you right now, once you get that number, I need you to cut that in half, because the reality is most of you overthink about this, and your number's not quite where it needs to be. And most have high expectations, and most likely your expectations will be hit, meaning to the downside. You will lose money. That's the guarantee in the market. You won't always win. So when this happens, you're going to be more prepared, and you're going to be at a free state of trading, which makes it more comfortable for you to trade. So again, please think about that number, and I want you to write down that number, okay? So now that you have that number, let's think about different ways that you can trade in the market with that number. Let's just say that your number is at $200. Okay, we're going to start with $200. I want you to look at this example on the screen right now. For far as options go, this is Apple. And I have this strike that I've selected here at 177.5. The options, let's just say they were going for 0.20 when I bought them. All right, so what does this mean? That means that there's a couple ways of looking at this, okay? I could buy $500 worth of these options, okay? And if I'm willing to lose $200, okay, that means basically the position would be cut almost in half, or a little bit more than half, depending on how you look at that, if you're including fees and so forth. That's one way. Another way to trade this is to say, all right, well, I'm willing to lose $200. So if I were to buy 10 of these and it cost me just 200 bucks at 20 cents, that I am willing to let this trade go to zero. Now listen to me. I don't want every trade to go to zero, but you have to have some sort of, realistic expectations when you take a trade. Like, it doesn't make sense. I'll tell you, I'll give you an example. There are some traders out there who tell me that they're willing to lose 200 bucks. Okay. They take 10 contracts, in this case, of the Apple at 20 cents, but they get out at 50%, or let's say 70%. And the next day, the position goes up, and they end up being really upset. They revenge trade. They continue to lose. Their emotions are out of whack. And I will come back and say something like, well, but you told me that you were willing to lose $200. So why didn't you just let this trade be, let it do its thing, right? You paid $200, which is your risk, so just let it go. It's okay if you let this type of position go to zero. Now let's say that you bought 1,000 of these, okay? Roughly at the price it's at right now, you'd be looking at 40 contracts, okay? So in that case, it's a little bit different. We can still put on a $1,000 trade and still stick to our actual risk tolerance of only $200. So you do the math and you understand what that would look like. how much would the stock have to come down in order for you to lose 200, and you would cut your losses at that point. So that's two different ways of looking at allocation. The next and probably the most important thing that I will tell you is this. Over time, and it's taken me a very long time, even up until today, to understand that the market does not care what type of setup you are about to take. So what I mean by that is at home, you're probably thinking like, well, my A plus setup is a breakout trade. I tend to do really well with these, so I'm going to take Apple to the upside on this breakout. It's my favorite trade. It's done me right in the past, and I'm going to spend $5,000 on it. Apple breaks out for a few seconds. Things are looking great. My 5,000 is now 6,000. And all of a sudden, some sort of catalyst comes out. The stock tanks, and all of a sudden I find myself at a $3,000 loss. Well, I'm pretty upset. And my next trade, I think to myself, well, it's Thursday. I want to buy a weekly option. Okay. And because, these expire tomorrow, I'm going to go ahead and make this trade a $200 trade. And so not like my other trade where I spent $5,000, but this time it's 200 because I would consider this a C plus setup. It looks good, but I don't have enough time. So I put 200 bucks in it. I wake up the next day and it's up 1,000%. Okay. Or let's just say 200%. So basically, you don't even make enough to cover your losses on the last trade, and the market did not care about your breakout thesis, and the market didn't care that you were buying on a Thursday and tomorrow's Friday. The market doesn't know you're there. If anything, take away from this, try to keep your allocation the same. Stop trying to grade your setups because, again, the market doesn't care. Understand what your risk tolerance is, and then I want you to cut that in half. And then from there, see if your trading gets any better. Even if you're paper trading, try this out for a couple weeks. Keep your allocation the same. Keep your rules the same. Maybe you have a stop on every position. That's okay. Just do that. Get your allocation, your risk tolerance down. And I think this is really going to help you out. If you have any questions, please reach out to me. If you want to check us out, go to trendytrading.co. We have a trial on right now where it's only $5 for 7 days, and you get to watch me trade live. And it's really unique here at Trendy Trading. We actually have our, every time I take a trade, it's sent to the room within milliseconds to show proof of concept. So you get to see when I enter, when I trim, when I close. It tells you if I lose, if I win. Very unique. We don't see anybody out there doing that. We're fully transparent. So I appreciate you. Thank you. We can't wait to see you, and we can't wait to trade with you. Happy trading. See you soon.